Joined on the air from the airport actually by Greg Zuckerman, who has details on some of the hedge funds that actually bet against JP Morgan's London Whaler and how much they profited. Greg, thanks for taking some time to be on the air with us here. How are you?
Sure thing. Good speaking to you guys.
So let's talk about this. We've known for a while, I think, right, that there were hedge funds out there that were betting against JP Morgan's positions, correct?
Yeah, we reported about a month ago about the so-called London Whale and about the guys who were taking positions on the other side. Some of them were betting that he couldn't hold on to these positions. Other people were just saying, hey, there's an aberration in the market caused by him. He was selling so much protection that it became really cheap for them to buy it. So now these guys are sitting on some nice profits.
Do we have any idea, this is an interesting question, do we have any idea how widespread was the knowledge that this guy was cornering this position? How many of these hedge funds are we talking about here? Was it a couple? Was it a lot? Was this really a common knowledge, this position, this trade?
Yeah, it was. I mean, in this world, in this sort of derivative trading world, there were dozens. I've reported it. We just put out a story. There were dozens of hedge funds and also other banks that were taking the other side of this trade.
Is this going to be, now, $2 billion, we know JP Morgan so far has lost $2 billion on this. That's a big loss for them. It's manageable for a bank of their size, but it's a big loss. Are the profits in that range also?
They add up to that, yeah. I mean, we're talking, the hedge funds I've reported so far only made 30, 40 million each, but it's widespread. There could be as many as 100 firms who've profited from this trade. And I also reported late last night that it was 2.3 billion of losses for JP Morgan, which is significantly more than 2 billion, and it could reach another billion.
Wow. Now, I mean, is this the kind of thing that we will, I mean, this sounds like, actually, this is pretty common practice, right? I mean, look, if JP Morgan's going to be out there selling protection, somebody else is always going to be on the other side of that, right?
Right. By definition, if they're going to have a huge position, someone's got to be on their side. It's not sort of common for there'd be a under-publicized unit within the biggest bank in the country making trades that shock their senior executives, or seemingly that's what they're saying right now.
Right. Listen, I want to play for a second a clip of Jamie Dimon from the press conference last night. This is one of the, no pun intended, money quotes. Let's listen to this for a second.
Didn't know whether they made
We've already said that this violated our principles, whether or not it violated Volcker principles, and you know, we want to run and build a great company. We do believe you need to have the ability to hedge in a CIO type position, and that Volcker allows that. This trading may not violate the Volcker rule, but it violates the Diamond principle.
Yeah. Hey, Greg, you heard that one about the Diamond principle. This is a big quote people are saying. What do you think the Diamond principle is in this case?
It's don't lose a lot of money. I'm not sure. I'm not sure beyond that what it means.
Yeah, you know, is the fact that this is a sort of common practice, the fact that you're talking about large, complex, convoluted trades, I mean, how much firepower do you think this is going to give critics of these kinds of trades and critics of putting public money behind these banks?
It raises all kinds of questions. I mean, frankly, it's only been a few years since the crisis. This is the biggest bank in the country. That they're having these kinds of losses, and that they're such surprising losses. It's not just the losses, but that the top guys themselves are so surprising. It undermines the whole view that we don't have to worry about too big to fail argument. It raises all the questions about too big to fail. If there's nobody like JP Morgan that's too big to fail.
Yeah, of course not. And I mean, look, this is what we're talking about here is a situation where this is how this market works, right? I mean, you get someone's selling, someone's buying. These trades are going on all the time. We have seen this. No, go ahead, Greg. I'm sorry.
Well, yes and no. I mean, frankly, banks should not be doing this. Hedge funds should be doing this. If you want to take a bet, then that's fine. JP Morgan is saying that this was a hedge that went awry. And it could be that part of this was a hedge that went awry, but my understanding is that this group did both hedging but also tried to make money.
Right. Yeah, you know, I think that's going to be a key point. He said this is a hedge. A lot of people are out there already saying this was not a hedge, this was a speculative, risky bet, and that sort of gets to the heart of everything, talking about the Volcker rule. Greg, we have to leave it there. Thanks. I appreciate your time talking to us from the airport. Greg Zuckerman, they're always out, got people out in the field there.